Something unusual is happening inside the silver market right now, and most investors still haven't noticed it. For years, people have claimed that the silver market was about to break. Most of those predictions turned into noise. But this time, the warning signs are different because they're not based on hype or speculation. They're coming directly from institutional data. Physical silver inventories are falling, delivery pressure is increasing, and global demand is quietly pulling metal out of the system faster than many expected. And the most important part, this process may have already started. London Vault inventories are the physical silver reserves stored inside the London Bullion system that support institutional trading and delivery. Recent data shows that silver stored in London vaults has dropped dramatically over the past few years. Back in early 2022, London vaults held around 1.24 billion ounces of silver. Today, that number has fallen to roughly 892 million ounces. That's a massive decline in a relatively short period of time. Even more important, a growing percentage of the remaining silver is now allocated, meaning it already belongs to specific owners and is no longer freely available to support new delivery demands. In simple terms, the pool of available physical silver is getting smaller while paper claims continue growing. Imagine a bank where customers collectively believe there's enough cash for everyone. The system works fine until too many people try to withdraw their money at the same time. The silver market operates in a very similar way. This trend suggests that institutional investors are becoming more interested in direct ownership of physical silver instead of relying only on paper contracts. The Shanghai premium is the extra amount buyers in China are willing to pay above the global silver spot price to secure physical delivery. Normally, this premium stays relatively small. But recently, it has remained unusually high for an extended period of time. That matters because it signals extremely strong physical demand inside China. In a balanced market, traders would quickly move silver from London into Shanghai to profit from the price difference. That process would normally push the premium back down. But the premium has remained elevated for weeks, which suggests that demand is absorbing incoming supply faster than the market can replace it. Think about a city experiencing a fuel shortage. Official fuel prices may stay low, but people begin paying extra just to secure immediate supply. That's similar to what appears to be happening with physical silver. China's aggressive buying activity may be creating long-term pressure on global silver supplies. COMEX registered silver refers to the silver inventory officially available for delivery against futures contracts. Although COMEX still reports large total silver inventories, only a small portion is actually available for physical delivery. At the same time, paper silver contracts represent hundreds of millions of ounces worth of exposure. Under normal conditions, this isn't a problem because most traders never ask for delivery. They simply trade price movements. However, if a larger number of traders suddenly demand physical silver, the available supply could become insufficient very quickly. Imagine 15 people holding ownership claims to the same car. Everything appears normal until several people attempt to collect the actual vehicle at the same time. The decline in registered inventory may reflect growing concern about relying entirely on paper silver exposure. Backwardation happens when the price of physical silver today becomes higher than the price of silver promised for future delivery. Normally, future contracts trade slightly above spot prices because storage and financing costs are built into the contract. But when traders begin prioritizing immediate physical ownership over future promises, spot prices can move above futures prices. That condition is called backwardation, and it often signals stress in the physical market. If bottled water suddenly becomes scarce during an emergency, people may pay more for immediate access instead of waiting for future deliveries. Institutional traders closely monitor backwardation because it can indicate tightening physical supply and rising delivery concerns. Historical comparison means analyzing current market behavior against previous periods of market stress. The silver market showed similar warning signs during both 2015 and 2020. Declining inventories, rising physical premiums, delivery stress, increasing lease rates. In both cases, silver prices eventually moved sharply higher. What makes the current situation different is the size and duration of the inventory declines. During the 2020 liquidity crisis, silver experienced a powerful rally after physical demand surged and supply chains tightened. History never repeats perfectly, but repeating patterns often reveal how markets behave under pressure. 3 possible outcomes. Scenario 1. Rapid price spike. Silver prices surge quickly, which slows demand and encourages more scrap supply to enter the market. This would likely create strong short-term volatility. Scenario 2. Long-term market stress. The market remains unstable for months while physical premiums stay elevated. Paper silver prices and physical silver prices may continue drifting further apart. Scenario 3. Structural breakdown in the paper market. Confidence in paper silver contracts weakens, triggering a rush for physical delivery. This is considered the lowest probability scenario, but potentially the most explosive. Final conclusion. The real question is no longer whether silver can rise in price. The bigger question is whether the paper silver system can continue functioning normally if physical supply keeps tightening. Physical supply keeps tightening. Right now, the warning signs are becoming harder to ignore. Vault inventories are falling. Physical premiums remain elevated. Lease rates are rising. Delivery stress is increasing. Individually, each signal may seem manageable, but together, they suggest that physical silver is becoming increasingly important in a market still heavily dependent on paper contracts. And if history repeats itself, the market could move much faster than most investors expect.